Hi and welcome to my channel. For those of you new, my name is Dave and I work in financial services, and these videos are a mixture of my journey and development towards financial freedom. They will cover financial products and they will also cover financial well-being across a numerous topics, so hopefully you can reach your financial goals and financial aims. Remember, if you like the videos, smash the like button, subscribe to this channel so we can grow and reach a wider audience. Now let's get into this latest week's video. This week's video is about staying calm during stock market crashes. If you look at the following chart that show the FTSE 100 over the last 5 years, give you a snapshot of the ups, the downs and what happens, but just as it's to iron out, there will be short-term blips, but the markets will always recover, shall we say. Look at the chart on the far left hand side. There was a sharp decrease in 2018 at the start of the year. At the end of the year, the market recovered, and then March 2020, COVID pandemic came, a sharp decrease, but again the market recovered. It rebounded to the end of 2020, and then a second shutdown appeared. Obviously the market somewhat decreased again. During 2021 the market somewhat recovered, not back to normality, but we did have a return of 14% increase in 2021 against a decrease of 14% during 2020. Now, since the FTSE 100 was incepted in the mid-80s, it's given an annual return of 8%. And if we're looking at recent events, obviously the tech stocks been out of favour since Christmas. We've got the conflict in Russia. Who knows what will happen moving forwards? There are sometimes more important things than investing, but it will give you an idea. Short-term sentiment does affect the market, but ultimately there will be blips, there will be increases, there will be bull runs, there will be bear markets, but the market is a long-term perspective to meet your investment needs. Whether you're a long-term investor, someone been in for a long while, we'll see the peaks and the troughs. May well be seeing the tech sector in the early 2000s, the banking sectors 2008, and the COVID pandemic in 2019, 2020. The market will recover, but do not get emotionally attached to the market and to individual shareholdings. As Warren Buffett said, there's a great sentiment, it's called Mr. Market. Psychological, he will have good days, he will have bad days, depending upon the market and what its implications are. There will always be buyers, there will always be sellers, but don't look at your portfolio every 5 minutes during a downturn. It will only give you stress. Okay, there's nothing you can do. Some things are beyond your control. It is how you react to that situation. Unfortunately, shall we say, the markets hate uncertainty, whether it's events happening now or events happening in future months. The market normally predicts events in 6 to 12 months down the road, so ride out the storm. The market will factor in future predictions, whether it's bank rate rises, interest rate rises, inflation. But do not panic and sell. You will only incur losses. But it may well be you're hit with some kind of double whammy. It may well be you paid fees to sell your investments. It may well be then you pay more fees when you buy back into those investments, double the costs. There's a great saying, shall we say, do not try and buy the dip. Leave that to seasoned investors, leave it to day traders. Time in the market is much better than timing the markets. A loss is only a loss on paper. It will only become a loss in real forms when it is crystallized and you make that decision to access. It may look good on paper portfolio if your portfolio has gone down 5-10% over a day or a week, but remember the markets will always recover. It is a long-term investing journey. Clearly, if you're putting money into the market, do it on a regular basis. Do what we call pound cost averaging or dollar cost averaging. Stick to your plan. Think long term. What are your financial goals for the next 12 months, 5 years, 10 years, or long term? Is it to be early retirement? Is it to be mortgage free? Is it your children's education? Remember, if the markets go down and you are buying shares on a regular basis, you're going to buy more shares, more units for that market price. A nice simple example, let's say you buy 100 shares at £1 a share. The shares go down to 90p. You still buy £100, but you've now got 111 shares. So you've got more shareholdings. May well be it gives you more dividends in future, but the average is the prices go up and down. You buy yourself as a dollar cost average, and over the course of time, whether it's funds, it's individual shareholdings, your performance will increase over the course of the coming weeks and months. You've bought them for a reason. You've bought them for the fundamentals of that company. As I said, they will have good days, they will have bad days. There will always be buyers, there will always be sellers of individual shares and funds. But buy them funds or shares for your investment objectives. On that basis, do we see the opportunities of a downturn, whether it's short term, long term, or a few weeks, as a buying opportunity? Can you take advantage of certain unloved stocks or certain affected sectors? Do your research, do your due diligence. Do you know about certain things? Do you work for a retailer and they're always busy, or there's no customers in the shop? Do you know about high street shops that have suffered during the pandemic? They've gone online, they've got great results. Are your supermarkets busy? Is everyone filling up with petrol, shall we say? Is everybody eating out in certain restaurants? So take advantage of what you know and certain things. As suffered during the recent COVID pandemic, the main strugglers, shall we say, travel, leisure, retailers. May well be some companies did good. Defensive stocks, utilities, shall we say, oil and gas companies, healthcare companies. So take advantage. Do you see it as a buying opportunity? Now, during the month of February, which just happened, is what we call results season. A lot of FTSE 100 companies will give results. The market has somewhat struggled during January and February, but there have been some great results. A quick answer from my ISA portfolio, it's about 45 to 50% invested in bank stocks because I see a recovery play. But in the past few days, the banking stocks of whole give great results. They've had share buybacks and the dividends have been increased. Just a few examples of some shares which I may see as buying opportunities, but it will give you a sentiment, okay? The markets have gone down, but there are some buying opportunities. Barclays Bank had results during February. Last year gave a dividend of 1p, it's now giving a dividend of 3p, final dividend, but its shares went down 10% on the day. Annual profits 2021, 8 billion versus 3.1 billion in 2020. Lloyds Banking Group, another example, dividend 0.57p in 2020, a final dividend of 1.33 in 2021, an annual dividend of 2p per share, again down 12% on the day, but results went from 1.3 billion a year to 6.9 billion. And again, NatWest, an example, final dividend of 7.5p, made a loss of 2020 of 351 million. It made a profit last year of 4.3 billion. So there are good companies there. They are affected by sentiment, but they are good long-term buying opportunities. It just happens to be companies I prepare to hold for the next few to 5 years because they will be recovery stocks, interest rates will go up, but it is going to give me some great dividends as the figures have just proved. Now, if you're not happy buying stocks, it may well be you buy ETFs, you diversify, okay? You've done it for a reason. It may well be you may not want 10 stocks all affected by the recent structures, shall we say. It may well be you want 100 shares, 500 shares such as an index, but buy them for diversification and hopefully it will de-risk your portfolio moving forwards. Remember, think long term. It is not a get rich quick journey and investing should be considered boring. So just to recap, the markets will go up and down as the FTSE chart showed in the video, but ideally the FTSE 100, the S&P, it gives a return of about 7 to 8% year in year to meet your investing targets. Remember, If you like the videos, smash the like button, subscribe to this channel, and we'll see you again soon.